As the smart electric vehicle landscape navigates a highly volatile period in late June 2026, NIO is managing sharp macroeconomic and policy shifts alongside historic operational delivery growth. The underlying equity is currently finding solid structural support as shares steadily consolidate near support in the $5.17 range. This technical compression reflects an intense market debate as investors weigh escalating global trade barriers and geopolitical friction against an undeniable structural turnaround in the company's core automotive business. Currently sitting at a market capitalization of $12.28 billion within a wide 52-week trading range of $3.34 to $8.02, NIO maintains a mixed hold consensus among analysts, with average price targets floating near $6.38. Institutional shareholders are focusing heavily on the immediate horizon, looking toward NIO's scheduled annual general meeting on Wednesday, June 24, 2026, for fresh corporate guidance regarding capital adjustments and overseas factory expansions necessary to bypass Western import caps. The ultimate anchor for NIO's market valuation is its explosive operational execution, underscored by massive multi-brand consumer adoption across its premium and mass market lines. For the month of May 2026, NIO achieved an all-time record high of 37,705 vehicle deliveries, marking a staggering 62.3% year-over-year increase. This powerful monthly surge propelled total year-to-date deliveries to 150,526 units, representing a massive 68.7% spike compared to the exact same period last year. This rapid volume expansion validates management's tiered brand architecture, successfully balancing steady demand for the core premium NIO brand, while aggressively rolling out its high-volume family and entry-level sub-brands, ONVO and Firefly. Following this record-breaking monthly delivery run, NIO's global cumulative lifetime deliveries have officially crossed a critical industry threshold, reaching a milestone total of 1,148,118 vehicles successfully delivered to the global market. This scaling delivery engine is finally resolving the structural margin pressures that have long fueled short-seller arguments against the company. In its Q1 2026 financial report published on May 21st, NIO fundamentally shifted the bull case by turning a surprise-adjusted profit of CNY 2 per share, easily crushing Wall Street consensus estimates that had confidently projected a net loss. Total quarterly revenue reached a massive moat of CNY 25.53 billion yen, or approximately $3.70 billion. Financial analysts point out that this definitive turn toward profitability stems from a combination of expanding manufacturing margins, falling overhead costs, and the compounding network effects of its automated battery swapping infrastructure. However, this spectacular operational momentum faces severe headwinds from an accelerating geopolitical battle with Western regulators. On June 8, 2026, the U.S. Department of Defense officially expanded its Section 1260H list of Chinese military companies operating in the United States, targeting NIO alongside state-backed internet and automotive giants like Alibaba, Baidu, and BYD. NIO responded immediately via an official investor relations update, directly stating that the Pentagon's designation is completely unjustified and baseless. The company firmly reiterated that it has absolutely zero ties to any military institutions, operates strictly as a commercial entity focused entirely on civilian consumer EV markets, and is working closely with legal experts to mount an aggressive challenge to the listing. This escalation has caused immediate geopolitical spillover, with Beijing expressing strong dissatisfaction over the overextension of national security concepts by U.S. authorities. At the same time, the broader trade environment continues to tighten as the United States and Canada align further on strict EV import caps aimed at containing Chinese vehicle manufacturing, forcing NIO to rethink its long-term global footprint.